Amber, of course, taking it on the chin. I think, what, 2,900, 2,925 now on Amber. Manish Gunwani is our market master of the day. He's Chief Investment Officer, Equity Investments at Nippon India Mutual Fund. Manish, great to have you with us here. Thank you very much. Assess the prospects for the market for us. Is this a good time to start nibbling, buying at lower levels? I mean, when markets are go and at very high levels, we all, of course, talk about how at lower levels one should start to buy. Markets have pulled back a little bit compared perhaps to historical precedent. This is not that much, but what is your sense?
So definitely this is a better time to buy than 1 month or 2 months back. I think if we look at the big global markets, I think this whole paradigm of inflation and interest rates, a lot of pain, I think, is priced into global equity markets right now. Globally, equity markets also have corrected. Slowly, we are converging with long-term multiples, whether it is the US market or the Indian market. To me, in terms of the wish list to buy, I think my only big concern is the currency, because if you look at the Indian currency, it has depreciated against the dollar, but if you see against a lot of major currencies like yen or yuan or won, it has outperformed quite significantly over the last 1 to 3 months. And just from a contra perspective, you feel, and one of the reasons why I think FIs are selling so heavily is a bit about the currency angle. I think if that is set right, which can happen if, let's say, if dollar weakens or we depreciate a couple of percentage more, I think we will have a much nicer setup. But definitely, I think the risk reward has improved over the last month.
Okay, the market's now moving higher, by the way. Just after that initial knee-jerk, the couple of stocks which are moving higher right now, supporting the market, Larsen & Toubro clearly stands out, and State Bank of India, which came out with numbers on Friday, is also now reacting on the positive side. Manish, good morning. The big derating has happened in the IT space, and I'm talking about the stocks from the highest point, but they have been the market leaders over the last 2 or 3 years. Do you reckon the market leadership has changed now, or would you use this dip to actually buy into IT? What would be your view?
So my view is it may not be the leading sector going forward. So for last 6 months, our view has been that the domestic cycle looks better than the global cycle. But because if you see the global cycle, US is facing a situation where both monetary and fiscal stimulus is being withdrawn, and now they have a very, very strong currency, which is not good for growth. And then Europe, Japan, China each have their own issues. So clearly the outlook for global growth being very strong from here cannot be a high probability kind of call. Whereas on the domestic side, whether you see from a 2 years perspective or 5 year, 7 year perspective, whether it's capex or exports or domestic consumption, India has gone through a fairly tepid cycle. So in that sense, we think that the risk reward is better in some of the domestic sectors rather than global sectors like IT.
Okay, Manish, hi, good morning. By the way, the market is picking up again, so the bulls need not lose hope entirely. The Nifty is up almost about 0.5% right now. The mid-cap index is up almost 1%. So look at that. I guess we have to be ready for some roller coaster ride before the markets recover in a in a consistent way. But today it's all over the place really. The dip has gotten bought. The space to look at really is cement. So Ultratech Cement, Shree Cement are the biggest losers now post this Adani deal. Both are down anywhere between 1.5% to 3%. So Manish, what do you do here? I mean, as someone who's managed money and who's invested in the cement space perhaps maybe for many years, how do you take a call when such a big player enters the market?
So I think it can have two trajectories. Such a large player entering a business, and if you take the analogy of telecom a few years back, it can obviously lead to derating of existing players because part of the growth for the next few years will obviously may be captured by the new entrant. But the other way to read it, and we don't know how it will play out, the other way to read it in a sector like cement, which is a lot of small players who are reasonably efficient and they are not very small by balance sheet size or size of operations, is that there will be more consolidation with selectively few stocks may do well. But I think the overall market cap of the sector going up too much looks unlikely because competition has obviously increased and a lot of the big players in this sector have been trading at a big premium in valuation to the smaller players. Now, the justification for that now loses ground a bit because with such a big player entering, the growth outlook for the bigger players may actually get derated and the chance of M&A happening for the big players is actually lower. So I think maybe you will see a bit of shift in relative value from larger players to the smaller players.
And the market's up a full 110 points now, so it's very light on the upside, so it's able to climb up very quickly. But if last week is any guide or the week before that, intraday volatility is so large, so huge, and so many times over that of course, very, very difficult to pass any verdict one way or the other. Amber, which Anuj highlighted earlier, is down 16% now, so it's actually lost more from that point on. Manish, just a quick word on, in a parallel way, but of course not exactly the same way, we have LIC listing right in front of us. What does that do, if anything, to other players in that space in terms of options for investors from a listed perspective? And of course, I mean, if you have any thoughts to offer on LIC itself and prospects for it, go ahead.
So we're quite positive on the private players in this space. I know the stocks have not done well over the last 6 to 12 months, but we see it as one of the few sectors which typically grows faster than GDP, which is consolidated, which has stable market shares with chances of pricing war being quite low, and it's quite underpenetrated. It is fairly urban, which given the current context of the economy where the affluent segment is doing better. So in many ways it ticks the boxes for a good stock segment over the next year or so. Now clearly we had this technical issue about LIC supply, and I guess that was one of the reasons why a lot of the private player stocks suffered. But we see that as a buying opportunity from a medium-term perspective. And generally we've seen that in a sector which is service-oriented, whether it is aviation or banking, over the long term, market share and profit pool has migrated to private players, and I guess the chances of that happening here also are quite high. So overall, we remain quite bullish on private life insurance players given attractive valuations at this point of time.
Manish, you at Nippon have one of the big pharma funds, right? What have you made of this big decline that we have seen in pharma after the COVID-induced big rally? The decline has been equally sharp, not just in pharma, but even in the other healthcare spaces, diagnostics as well. How are you approaching this space now?
So this space has different kinds of players, right, from pure export CRAM players to mix of domestic and US generic players to hospitals to diagnostics. I think there are different moving parts for each. Overall, we think the sector now is quite attractive. I think part of the reason was the domestic business is also benchmarked to FMCG valuation, right? So when FMCG valuations have corrected, maybe the domestic business has also got derated a bit. The growth with COVID base and the fact that commodity inflation has hit gross margins, US generic pricing, I don't think can go worse from here. So if we look forward, a lot of the pain in terms of high commodity prices, US generic pricing erosion, derating of FMCG multiples, I think a lot of the pain is in the stocks. Again, I think from a 2-3 year perspective, there are definitely selective stocks here which can generate very good returns.
Right, Manish, we'll leave it at that. Thanks a lot for joining us.